Before we begin, please remember that I am not a licensed financial advisor or insurance agent. This presentation is for informational and educational purposes only. The information provided is based on research and experience, but it is not a substitute for professional advice tailored to your specific situation. Always consult with a qualified professional before making any financial decisions. Your insurance needs are unique, and the strategies discussed here may not be suitable for everyone. You are being systematically overcharged for car insurance. It's not an accident, it's not bad luck, and it's not your fault. It's the system. It's a quiet, calculated process that siphons hundreds, sometimes thousands, of dollars out of your bank account every single year. And most people have no idea it's even happening. Think about it. You get that renewal notice in the mail or that email in your inbox. You open it and your heart sinks just a little. The price went up. Again, you haven't had an accident. You haven't gotten a ticket. Your car is a year older and worth less, so why on earth are you paying more? You call them up, and you get a polite, scripted answer about rising costs in your area or new rating factors. It's vague, it's confusing, and it's designed to make you give up, shrug your shoulders, and just pay the bill. Because what's the alternative? Driving without insurance is illegal and financially catastrophic. So you pay it, and the machine keeps running. Well, today we are throwing a wrench in that machine. In this video, I'm going to pull back the curtain on the auto insurance industry. I'm going to show you the psychological tricks, the pricing algorithms, and the hidden rules they use to maximize their profits at your expense. But more importantly, I'm going to give you the exact playbook to fight back. These aren't temporary hacks or flimsy loopholes. These are timeless, powerful strategies that will put you back in the driver's seat of your finances, potentially saving you 20, 30, or even 50% on your premiums, year after year. We're going to turn you from a passive bill payer into a savvy, informed consumer who gets the best possible rate without sacrificing a single bit of the crucial coverage you need to protect yourself and your family. So, let's start with the single biggest lie in the auto insurance world. It's a myth so pervasive, so deeply ingrained in our culture, that we accept it as fact. It's the myth of the loyalty discount. It sounds so good, doesn't it? Stay with us, be a loyal customer, and we'll reward you with better rates. It's a comforting thought. It makes you feel valued. Unfortunately, in many cases, it's a complete fantasy. In reality, your loyalty is often punished. The industry has a quiet little term for this. It's called price optimization. It's a fancy way of saying they use vast amounts of data to figure out which customers are least likely to shop around for a better deal. And guess who they think is the least likely to leave? The loyal customer. The person who's been with them for 5, 10, even 15 years. They know you're busy. They know comparing insurance quotes is a hassle. They are betting on your inertia. They are betting that you'll see that 5% or 10% rate hike and think, ugh, I don't have time for this, and just pay it. So they slowly, incrementally raise your rates over time. It's like a frog in a pot of slowly boiling water. You don't notice the small changes until one day you wake up and realize you're paying a fortune. This is the loyalty penalty, and it is costing American drivers billions of dollars. Let me paint you a picture. Let's say there are two drivers, Sarah and Tom. They live on the same street, drive the same kind of car, have identical driving records, and the same credit score. They are, for insurance purposes, identical twins. The only difference is that Sarah switches her insurance company every 2 years, always looking for the best deal. Tom, on the other hand, has been with reliable auto insurance since he got his license 10 years ago. He's proud of his loyalty. Who do you think pays less? It's not even close. Sarah is likely paying hundreds of dollars less per year than Tom. Why? Because every 2 years, Sarah re-enters the marketplace as a new customer. Companies are fighting for her business. They roll out the red carpet, offering their best introductory rates and new customer discounts to win her over. She is a prize to be won. Tom, meanwhile, has become a predictable, stable source of income for his insurer. They don't need to win him over. They already have him. So they use their price optimization algorithms and determine that Tom can probably tolerate a 6% rate increase this year without leaving. Next year, maybe it's 4%. The year after, 7%. None of these increases are tied to his risk as a driver. He's still a perfect driver. They are tied to his predicted behavior as a consumer, his behavior of staying put. His loyalty isn't being rewarded, it's being monetized. So, what is the single most powerful weapon you have against the loyalty penalty? It's incredibly simple, yet most people fail to do it. You must shop your insurance. Period. This isn't a suggestion. It's a non-negotiable rule of personal finance. You should be getting quotes from other insurance companies at least once a year, or at a bare minimum every time your policy is up for renewal. Think of it as an annual financial checkup. You wouldn't go 10 years without seeing a doctor, so why would you go 10 years without checking if you're overpaying by thousands of dollars on a major household expense? The best times to do this are about 30 days before your current policy renews. This gives you plenty of time to compare offers and make a smooth transition if you decide to switch. Other critical moments to shop are after any major life event. If you move, get married, buy a house, change jobs, or if your credit score significantly improves. All of these things can dramatically change your risk profile and open you up to much better rates from a different company. Now, I can hear the objections already, but it's such a hassle. It takes so much time. 20 years ago, that was true. You had to call a dozen different agents, repeat the same information over and over, and wait for them to mail you a quote. It was a nightmare. But today, in the digital age, that excuse is dead. There are countless online tools and comparison websites that allow you to get quotes from 10 or more companies in about 15 minutes. You enter your information once, and the offers come to you. It is one of the highest paying 15-minute jobs you will ever have. If you spend 15 minutes and find a way to save $400 a year, you just paid yourself $1,600 an hour for your time. Find me another side hustle that pays that well. The other fear people have is about their credit score. Won't getting all these quotes hurt my credit? This is a critical misunderstanding. When you apply for a loan or a new credit card, lenders do what's called a hard inquiry on your credit, which can temporarily lower your score by a few points. But when you get an insurance quote, the insurance companies use a soft inquiry. Soft inquiries have absolutely zero impact on your credit score. You can get 100 insurance quotes in a single day, and it will not change your credit score by a single point. The credit bureaus know you're just shopping, and the system is designed to allow for that. So the first, most fundamental step to saving money is to break the cycle of blind loyalty. You have to make the insurance companies compete for your business every single year. It's not about being disloyal. It's about being a smart consumer. Your goal isn't to be best friends with your insurance company. Your goal is to get the best possible protection for your assets at the lowest possible price. By shopping around, you're not just finding a cheaper price. You are actively reminding the entire industry that you are an informed, proactive customer who will not be taken for granted. You are resetting your value in the marketplace. And that simple act of shopping is just the first step. It's the gateway to unlocking a whole world of savings. Because the loyalty penalty is just the visible part of the iceberg. What's lurking beneath the surface, the hidden discounts, the misunderstood coverages, and the rating factors you can actually control, is where the truly massive savings are found. And we're about to dive into all of it. Let's start with the most fundamental truth that most drivers miss. Your auto insurance premium isn't just a number pulled out of a hat. It's the output of a complex, cold, and calculating algorithm. It's a risk assessment of you, your vehicle, and your environment run through a massive database of statistics. Think of it like a secret score. Your job isn't to fight the algorithm. Your job is to understand it, and then give it exactly what it wants to see to give you the lowest possible price. So, what are the core ingredients of this secret score? The first and most heavily weighted is you, the driver. This goes way beyond just your driving record. Of course, a clean record is king. No at-fault accidents, no speeding tickets, no DUIs. That's the baseline. Every ticket, every fender bender, is a red flag to an insurer that says, this person costs us money. They track this stuff for years, typically 3 to 5, but major violations can haunt your record for a decade or more. This is non-negotiable. Driving safely is the #1 way to keep your rates down over the long term. But what about the things that feel less fair? Let's talk about age. If you're under 25, you already know the pain. You're statistically more likely to get into an accident. It's not personal. It's pure data based on millions of drivers. Insurers see a young driver and their risk calculator lights up like a Christmas tree. The good news? This gets better. Every year you drive without an incident, you are proving their statistics wrong. You're building a personal track record of safety, and with each passing birthday, especially after you hit 25, you'll see those rates begin to drop naturally, assuming your record stays clean. Now for the one that makes people's blood boil, your credit score. Let's be crystal clear about this. Insurance companies are not supposed to use your standard FICO score, the one you use for a mortgage. Instead, they use something called a credit-based insurance score. And no, it has nothing to do with how much money you have in the bank. They are legally barred from considering your income. So what are they looking at? They're looking at patterns of financial responsibility. Do you pay your bills on time? How much debt are you carrying relative to your limits? How long have you had credit? The insurance industry has spent billions on actuarial studies that show a strong statistical correlation, not a causation but a correlation, between how a person manages their finances and how they manage their risk behind the wheel. The logic from their perspective is that someone who is meticulous about paying bills on time might also be more meticulous about vehicle maintenance and obeying traffic laws. Is it fair? That's a hot debate. But is it a reality in every state except California, Hawaii, and Massachusetts? Absolutely. Improving your financial habits and paying bills on time can have a direct, and often dramatic, impact on what you pay for car insurance. It's one of the most powerful and most overlooked levers you can pull. Okay, so that's the U factor. Next up is the machine itself, your vehicle. What you drive is almost as important as how you drive. A brand new $60,000 German sports car is going to cost more to insure than a 10-year-old Honda Civic. This seems obvious, but the reasons are more nuanced than you think. It's not just about the sticker price. First, there's the cost of repair. That German sports car has specialized parts, complex electronics, and requires highly trained technicians. A minor fender bender could result in a 5-figure repair bill. The Honda Civic? Parts are cheap, plentiful, and nearly any mechanic can fix it. The insurer is always thinking about the worst-case scenario. What will it cost them to make you whole after a crash? Second is the safety rating. Cars with high marks from the Insurance Institute for Highway Safety, or IIHS, often get lower premiums. Why? Because features like automatic emergency braking, blind spot monitoring, and a robust frame mean you're less likely to get into an accident in the first place. And if you do, the occupants are less likely to be seriously injured. Fewer injuries mean lower medical payouts for the insurance company. This is a pure win-win. A safer car for you means a lower risk for them. When you're car shopping, looking up the IIHS top safety pick list isn't just a smart safety move. It's a smart financial move. Third is the likelihood of theft. Some cars are just magnets for thieves. Year after year, vehicles like the Honda Accord, Ford F-150, and Chevrolet Silverado top the most stolen list. If you own a vehicle that's popular on the black market for parts, your insurer knows this. They have the data. Your rate for comprehensive coverage, which is what pays out for theft, will be higher. On the flip side, having anti-theft devices can help counteract this. A passive alarm that arms itself, a vehicle recovery system like LoJack, or even simple VIN etching on the windows can be enough to qualify you for a small but meaningful discount. So we have the driver and the vehicle. The final piece of this primary puzzle is your environment and usage. Let's start with where you live. Your zip code is one of the most powerful rating factors there is. Moving just 5 miles down the road from a dense, urban center to a sleepier suburban town can slash your premium by hundreds of dollars a year. Why? Again, it's all about risk and statistics. Insurers analyze your specific zip code for the frequency of claims. They look at traffic density, the number of accidents, the rate of car theft and vandalism, and even weather patterns. If you live in Hale Alley through the plains or a hurricane-prone coastal region, the risk of comprehensive claims goes up. If you live in a state where lawsuits are common and jury awards are high, the liability portion of your premium will be more expensive. You're not just being rated on your own driving. You're being rated on the collective risk of everyone around you. You're paying for your neighbor's bad driving and the local crime rate. It's frustrating, but it's a critical part of the formula. Finally, there's how you use your car. When you get a policy, the insurer will ask you for your estimated annual mileage. Be honest, but be realistic. The less you drive, the less exposure you have to a potential accident. Someone with a 10-minute commute who drives 7,500 miles a year is a much lower risk than a traveling salesman who racks up 25,000 miles a year. With so many people now working from home or in hybrid roles, this is a huge area for savings. If your driving habits have changed, you must tell your insurance company. You could be overpaying significantly because your policy still reflects a pre-pandemic commute you no longer make. They'll also ask if you use the car for pleasure, commuting, or business. Business use, like for rideshare or delivery, carries the highest risk and requires a special type of policy. Using your personal car for business without telling your insurer is one of the fastest ways to have a claim denied. So there you have it. the driver, the vehicle, the location, and the usage. These are the 4 pillars that your entire insurance premium is built upon. They are the core of the algorithm. It's not a mystery box. It's a calculation based on these fundamental inputs. Understanding this is the absolute first step to taking control. Because once you understand the questions on the test, you can start figuring out how to give the right answers. Now that you know precisely how they are judging you, we can move on to the fun part, using their own system and their own rules to systematically dismantle your premium piece by piece. We're going to turn the tables. And it all begins by dissecting the single most important page of your policy, the declarations page, and finding the hidden opportunities for savings that are hiding there in plain sight. Think of your declarations page not as a bill, but as a battle plan. It's the blueprint of your entire policy, and nearly every line item is a potential lever you can pull to lower your costs. Most people get this document in the mail or as a PDF, glance at the total premium, and file it away forever. That is a massive mistake. This single piece of paper holds the keys to the kingdom. So let's open the door. Pull up your policy right now if you can. We're going line by line. The first thing you'll see is a list of your coverages, and they probably look like a secret code, a jumble of names and numbers. Let's decipher them. The big one is liability. This is the cornerstone of your policy. It's the coverage that pays for damage you cause to other people and their property. This isn't for you, it's for them. You'll see it written as 3 numbers, like 50/100/25. This isn't a random lottery number. It means your policy will pay up to $50,000 for bodily injury to one person, up to $100,000 total for bodily injury for the whole accident, and up to $25,000 for property damage. Now, every state has a legal minimum, and it is shockingly low. In some states, the property damage minimum is just $5,000 or $10,000. Think about that. What happens if you slide on some ice and hit a brand new Tesla or a BMW? That $10,000 is gone in a puff of smoke, and the rest comes out of your pocket. Your savings, your assets, your future wages could all be on the line. Here's the counterintuitive truth. The first place to save money is not by slashing your liability coverage to the state minimum. In fact, raising it is one of the best bargains in insurance. The jump from, say, $50,000 in property damage to $100,000 might only cost you a few extra dollars a month. It is the cheapest peace of mind you can buy. We aren't cutting this. We're making a smart, informed decision to protect ourselves. The real savings are coming up next. Let's look at the next 2 lines. Collision and comprehensive. These are the coverages that pay to fix your car. Collision is exactly what it sounds like. It covers damage from a collision with another car or an object, like a pole or a guardrail. Comprehensive is for almost everything else. Think of it as the acts of God and acts of crooks coverage. A tree falls on your car, a rock cracks your windshield on the highway, a hailstorm turns your hood into a golf ball, or your car gets stolen. That's comprehensive. If you have a loan or a lease on your car, the bank requires you to have these. You have no choice. But if you own your car outright, these are optional. And right next to these 2 coverages, you'll see a number that is arguably the most powerful tool you have for instant savings, your deductible. The deductible is the amount of money you have to pay out of your own pocket for a claim before the insurance company pays a single dime. Let's say you have a $500 deductible, and you get into an accident that causes $3,000 worth of damage. You pay the first $500, and the insurance company covers the remaining $2,500. Simple. Here's the magic. The higher your deductible, the lower your premium. Always. Insurance companies see a high deductible as you taking on more of the risk yourself. It tells them you're less likely to file small piddly claims for every little scratch and dent. And for that, they reward you with a significantly lower price. Look at your declarations page. What is your deductible? Is it $250? $500? Many people default to a low deductible because it feels safer. But that safety is costing you a fortune. The difference in your annual premium between a $250 deductible and a $1,000 deductible can be staggering. We're talking a potential savings of 15 to 40% on your collision and comprehensive costs. That could be hundreds of dollars a year every year. The key question you must ask yourself is this: what is the highest deductible I can comfortably afford to pay tomorrow, in cash, without it ruining my life? If you have $1,000 or more saved in an emergency fund, there is almost no reason to carry a low $250 or $500 deductible. You are essentially prepaying with interest for a disaster that might never happen. You are paying your insurance company a premium to hold on to your own emergency money. Raise that deductible to a level your emergency fund can support and watch your premium drop. That is your first immediate win. But that leads to the second, even bigger question. Should you even have these coverages at all? This is where we talk about the old car dilemma. Insurance companies don't care what you paid for your car. They don't care about its sentimental value. They only care about one thing: its actual cash value, or ACV. That's the market value of your car the second before the crash, taking into account its age, mileage, and condition. It's what a willing buyer would pay for it. Now let's do some simple math. Go to a site like Kelley Blue Book or Edmunds and look up the private party value of your car. Be honest about the condition. Let's say your trusty 12-year-old sedan is worth about $3,500. Now look at your declarations page again. Find the annual cost for your collision coverage and your comprehensive coverage. Add them together. Let's say that total is $600 for the year. You are paying $600 a year to protect a $3,500 asset. If you totaled your car tomorrow, the insurance company would write you a check for $3,500 minus your deductible. If you have a $1,000 deductible, you'd get a check for $2,500. But you paid $600 for that privilege. Is it worth it? Maybe. But what about next year? You'll pay another $600, and your car's value will have dropped to maybe $3,000. The year after that, you'll pay another $600, and it's worth $2,500. At some point, the cost of the insurance becomes absurdly high relative to the potential payout. A common rule of thumb is that if the annual cost of your collision and comprehensive coverage is more than 10% of your car's value, it's time to seriously consider dropping them. In our example, 10% of the car's value is $350. We're paying $600. It's time to cut the cord. By dropping these coverages on an older paid-off car, you are essentially choosing to self-insure. You take the money you would have paid the insurance company, that's $600 a year, and you put it in a dedicated savings account for car repairs or a down payment on your next vehicle. This one move can cut your insurance bill in half, or even more. It's a calculated risk, but for millions of Americans driving older cars, it's a risk that makes perfect financial sense. Okay, let's keep moving down the page. You might see coverages like uninsured or underinsured motorist, often abbreviated as UM/UIM. This is crucial coverage. Remember how we talked about people driving around with the bare minimum liability insurance? What happens when one of them hits you and you're facing a mountain of medical bills? Their pathetic $25,000 of coverage won't even be a down payment on your hospital stay. That's where this coverage kicks in. It protects you and your family from irresponsible drivers. The tip here isn't to cut it, but to understand it. A good strategy is to set your UM/UIM limits to be the same as your own liability limits. It creates a consistent level of protection, whether you're the one at fault or the victim. Finally, you'll see things like medical payments, MedPay, or personal injury protection, PIP, depending on your state. This covers initial medical expenses for you and your passengers after an accident, regardless of who is at fault. It's designed to pay out quickly for things like ambulance rides and emergency room visits. Here lies another hidden savings opportunity. If you and your family are covered by a very good health insurance plan with a low deductible, you may already have excellent coverage for injuries. In that case, you might be able to opt for a lower level of MedPay or PIP coverage on your auto policy, as your health insurance would be your primary safety net for major medical costs. Check your health policy details first, but coordinating these two policies can shave a little more off your premium. So let's recap what we've done. Just by reading and understanding this one page, we've identified 4 massive action items. First, we've confirmed our liability limits are high enough to actually protect our assets. Second, we've found our deductible and asked if we can raise it based on our emergency fund. Third, we've calculated the value of our car versus the cost of collision and comprehensive to see if it's time to drop them. And fourth, we've checked our medical coverages to see if they overlap with our health insurance. This is how you deconstruct a policy. You stop seeing it as a single non-negotiable price and start seeing it as a collection of individual choices, each with its own cost and its own lever for savings. We've just optimized the policy itself, but we've only scratched the surface. All of this was about adjusting the numbers already on the page. What about the things that aren't on the page? The secret handshakes, the hidden discounts, the special rates that your insurance company knows about, but doesn't automatically apply? They have a list, and you're probably eligible for more than you think. But they won't just give them to you. You have to ask. And knowing exactly what to ask for, well, that's our next mission. This is a treasure hunt. Your insurance company has a vault filled with discounts, but it's not marked on any map. Think of it like a secret menu at a restaurant. The items are there, they're available, but they're only served to the customers who know to ask for them by name. Your agent isn't a mind reader, and frankly, it's not their job to volunteer ways to lower your bill. Their job is to answer your questions. So our mission is to arm you with the right questions. We're going to build your personal discount checklist, a master key that can unlock hundreds, even thousands of dollars in savings. Let's start with the discounts centered around you, the driver. These are the ones tied to your habits, your education, and your skills behind the wheel. The most common one you hear about is the good student discount. Now, don't tune this out if you're not in high school. This often applies to full-time college students up to age 25. The requirements are usually straightforward. Maintain AB average, a 3.0 GPA, or be on the dean's list or honor roll. For an insurer, statistics show that a student who is responsible in the classroom is more likely to be responsible on the road. It's a simple correlation, and they will pay you for it. If you have a young driver on your policy, this isn't just a small perk. It can slash their portion of the premium by as much as 25%. That's not chump change. That's a textbook in pizza for the semester kind of savings. Next up is the defensive driving course discount. Many people think these courses are just for getting points taken off your license after a ticket. That's a reactive way to think. We're being proactive. Insurance companies love when you voluntarily complete an approved defensive driving or accident prevention course. Why? Because you are literally training yourself to be a lower risk. You're investing your own time to become a safer driver. They reward that investment. These courses can often be done online in a single afternoon for about 25 or 30 bucks. The discount you get in return can last for 3 years and often saves you 5 to 10% on your premium. Do the math. If your annual premium is $1,500, a 5% discount is $75 a year. For a 3-year period, that's $225 in savings from a $30 course you took one Saturday. That's an incredible return on investment. Then there's the big one. The safe driver or good driver discount. This sounds obvious, but it has layers. The basic level is simple. No accidents, no violations, no claims for a certain period, usually 3 to 5 years. This is the insurance company's way of saying, thank you for not costing us money. But there's a premium version of this you need to ask about. Some companies offer accident forgiveness. This is a feature where your first at-fault accident won't cause your rates to skyrocket. It's like a get-out-of-jail-free card for your premium. Another variation is the vanishing deductible, where for every year you go without a claim, your deductible decreases, sometimes all the way to zero. These are loyalty rewards for your good behavior, but they are often riders or add-ons that you have to specifically inquire about and enroll in. Now let's shift from you, the driver, to the policy itself. This is where the structure of your insurance can unlock massive savings. The king of all discounts is the multi-policy discount, also known as bundling. Insurance companies don't just sell auto insurance. They sell homeowners, renters, life, boat, and umbrella insurance. They want to be your one-stop shop. The reason is simple: customer retention. If you have both your auto and home insurance with them, you are statistically far less likely to shop around and leave. It's just more of a hassle. To get you to stay, they're willing to offer a huge discount, sometimes up to 25 or 30% across the board. If you're a homeowner, this is a no-brainer. But even if you're a renter, don't ignore this. Renter's insurance is incredibly cheap, maybe $15 a month, but bundling it with your auto policy could save you $20 a month on your car insurance. You literally get paid to take on more coverage. It's one of the few true win-wins in finance. Closely related is the multi-car discount. If you have more than one vehicle in your household, they should be on the same policy. The discount is based on the idea that one person can only drive one car at a time, lowering the overall risk. This isn't just for married couples. It can apply to roommates or a parent and a child living at the same address, as long as the vehicles are garaged at that location. Here's a discount that's pure math. The paid-in-full discount. Most of us pay our premium monthly. Feels more manageable. But insurance companies often charge you for that convenience. They add a small service fee to each monthly payment, maybe $5 or $8. It doesn't sound like much, but that's up to $96 a year you're paying for the privilege of giving them their money slowly. If you can afford to pay your 6-month or 1-year premium all at once, you can often get a significant discount by avoiding these fees. Think of it this way. Paying those fees is like getting a zero-interest loan from yourself. Paying in full is an immediate guaranteed return on your money. It's simple, clean, and you should always ask what the price difference is. Paired with that are the easy ones. The automatic payment and paperless billing discounts. You can save $25 or $50 a year just for letting them pull from your bank account and for getting emails instead of letters. It saves them money on printing and postage, and they pass a tiny fraction of that back to you. It's the easiest money you'll ever make. Next, let's talk about the car itself. Your vehicle is a rolling collection of potential discounts. You need to do an audit of your car's features. Start with safety. Modern cars are packed with technology that makes them less likely to crash and safer when they do. This isn't just about airbags and anti-lock brakes anymore. Does your car have daytime running lights? Electronic stability control? A lane departure warning system? Blind spot monitoring? Automatic emergency braking? These are all specific line items on an underwriter's checklist. Your insurance company might not know your trim level came standard with these features. You have to tell them. Then there's anti-theft. If your vehicle has any kind of anti-theft device, it's worth a discount. This ranges from simple VIN etching on the windows to passive alarms that arm themselves automatically when you lock the doors, all the way up to a GPS tracking system like LoJack. Each level of protection reduces the risk of theft, which is a major component of your comprehensive coverage. Again, the insurer won't know unless you tell them. Finally, we arrive at the most secretive and powerful category of discounts: affinity discounts. This is where your identity, your career, and the groups you belong to can save you a fortune. Insurance companies are all about statistics. They form partnerships with organizations whose members are, on average, lower-risk drivers. This is where you need to take inventory of your life. What is your occupation? Actuaries have identified certain professions as being more cautious. Teachers, engineers, scientists, nurses, firefighters, and police officers often qualify for a professional discount. Beyond your job, what groups do you belong to? Are you a member of a wholesale club like Costco or Sam's Club? They have partnerships. Are you a member of a credit union? They almost always offer a discount. Did you graduate from college? Check with your alumni association. Many have negotiated group rates for their members. Are you a member of a professional organization, like the American Medical Association or the Bar Association? That's a discount. ARP for seniors? That's a huge one. Even certain fraternities and sororities have deals. You have to think about every single group you are a part of. These organizations have already done the negotiating for you. You are part of tribes that have a standing deal on the table. You just have to raise your hand and claim it. So now you have the list. You have the secret menu in your hands. Driver discounts, policy discounts, vehicle discounts, and the hidden gem of affinity discounts. Your mission is to go through this list line by line and see which ones apply to you. Create your personal checklist. But having the list is only step one. Knowing what to ask for is half the battle. Knowing how to ask, when to ask, and how to leverage this information to make insurers compete for your business, that's the other half. And that's where we're going next. You have the codes. Now it's time to learn how to input them to truly master the game. So let's talk about inputting those codes. The first and most critical step in this game isn't calling anyone. It's not filling out a single online form. It's preparation. Think of it like a high-stakes poker game. You would never sit down at the table without knowing the rules and counting your chips. Going into a negotiation with an insurance company unprepared is the same thing, and they are counting on you to do just that. First, you need to assemble your dossier. This is your personal file of everything an insurer will need to give you an accurate quote. Don't go searching for this stuff while you're on the phone or halfway through an online form. Have it all in one place ready to go. What's in the dossier? The full name, date of birth, and driver's license number for every driver in your household. The vehicle identification number, or VIN, for every car you want to insure. You can find this on your current insurance card, your vehicle registration, or on the driver's side dashboard of your car, visible through the windshield. You'll also need the address where the vehicles are primarily kept, an estimate of your annual mileage for each car. Be honest, but be strategic. If your commute just got cut in half because you're working from home 3 days a week, that's a massive update. Finally, have your current policy declaration page in front of you. This is the single most important document in this entire process. It's the blueprint of your current coverage. This brings us to the second non-negotiable rule of mastering the game. You must compare apples to apples. This is where 90% of people go wrong. They get a quote from Company A for $900 and a quote from Company B for $700, and they immediately think, wow, Company B is $200 cheaper. I'm switching. But they fail to realize that Company B quoted them state minimum liability limits, a $2,000 deductible, and no rental car reimbursement, while their old policy had robust protection that would have saved them from financial ruin in a serious accident. The cheaper quote wasn't cheaper, it was just less. It was a worse product. You cannot make an informed decision unless the quotes are for the exact same thing. Your current policy declaration page is your guide. When you talk to an agent or fill out a form, you are not asking for a quote. You are asking them to quote you for a policy with these specific coverages: $100,000 in bodily injury liability per person, $300,000 per accident, $50,000 in property damage. The same for your uninsured and underinsured motorist coverage. A $500 comprehensive deductible. A $500 collision deductible. You match every single line item perfectly. Only then, when you have 3 or 4 quotes with the exact same numbers, can you truly see who is offering the best price. Okay, you've got your dossier. You understand the apples-to-apples mandate. Now, where do you go to get these quotes? This isn't about just picking one company. This is about creating a competitive environment. You need to launch a 3-pronged attack to canvass the entire market. Prong 1 is the direct-to-consumer carriers. These are the companies you hear on the radio all the time: the Geicos, the Progressives, the Esurances of the world. Their model is built on cutting out the middleman. You deal with them directly, usually online or through a call center. The upside is they can sometimes offer very competitive rates because their overhead is lower. The downside is that you are the one doing all the work, and you don't have a personal agent to advocate for you if something goes wrong. You are just a policy number in a massive system. Get a quote from 1 or 2 of the big ones. Prong 2 is the captive agents. These are the agents for companies like State Farm, Allstate, or Farmers. They are captive because they can only sell you insurance from one company, theirs. The benefit here is that you get a personal relationship. You have a local agent, a real person you can call or visit who gets to know you and your needs. They can be fantastic resources and often find discounts specific to their company that a website might miss. The downside: their loyalty is to their company, and they can only offer you one set of prices. If their company's rates are high for someone with your profile that year, they have nothing else to show you. Pick one major captive agent in your area and get a quote. Now for prong 3, the secret weapon that most people completely overlook: the independent insurance agent or broker. Unlike a captive agent who works for one company, an independent agent works for you. They have contracts with a dozen, sometimes more, different insurance companies. Their job is to take your dossier and do the shopping for you. They'll take your information to all their partner companies, companies you may have never even heard of, and bring back the best options. This is the single most efficient way to shop for insurance. They know the market inside and out. They know which companies are currently offering the best rates for drivers with your specific profile in your specific zip code. They get paid a commission by the insurance company they place you with, so there's no direct cost to you for their service. This is the ultimate leverage. You are outsourcing the entire shopping process to a professional who has access to deals you can't find on your own. So now you're talking to these agents and companies. What do you say? This isn't just about giving them your information. You need to actively guide the conversation. Have a playbook. Ask them directly, based on the information I've given you, are there any other discounts I might qualify for? Ask them to walk you through the discounts they've already applied. You might hear them say, "Oh, I see you have a master's degree. We have an alumni discount for that." Or, "I didn't realize your car had anti-lock brake standard. That's another 3% off." You have to probe. Then, use hypotheticals to understand the value of your choices. Ask, what would my premium be if I raised my collision deductible from $500 to $1,000? The answer might be a savings of $20 a year, in which case it's not worth the extra risk. Or it might be a savings of $200 a year, making it a brilliant financial move. You won't know unless you ask. Ask about bundling. I also have a home/renters policy with another company. What would the total price be if I moved that over to you as well? Sometimes the multi-policy discount is so massive it's a no-brainer. Once you've executed your 3-pronged attack, you'll have several apples-to-apples quotes in front of you. Let's say your current insurer is charging you $1,500 a year. A direct carrier quoted you $1,300, and an independent agent found you a fantastic, A-rated company for $1,100. Your work is not done. Your final move is leverage. You call your current insurance company. You don't call to cancel. You call with respect and information. You say, "Hi, my policy is up for renewal next month, and as part of my annual financial review, I've been getting some other quotes. I've been a loyal customer for 6 years and I really love your service, so I wanted to call you first. I have a quote here from another A-rated company for the exact same coverage for $1,100. Is there anything you can do to match that or get closer to it? I'd much rather stay with you if we can make the numbers work." You've just changed the entire dynamic. You're not an angry customer. You're a savvy, loyal customer giving them a chance to keep your business. You've complimented them, stated your loyalty, presented a factual, competitive offer, and put the ball in their court. Sometimes, they'll have a customer retention department that can apply special discounts to keep you. They might magically find $150 in savings. Other times they can't and they'll say so. Either way, you get the best possible price, whether it's with them or with your new cheaper option. And the final piece of this strategy, timing. The absolute worst time to shop for insurance is the week your policy expires. You're rushed, you're desperate, and you'll make mistakes. The golden window is 30 to 45 days before your renewal date. This gives you plenty of time to gather your dossier, contact multiple agents, get your quotes back, and make a calm, rational decision. It also gets you a new business quote from other companies, which is often lower than a last-minute panic quote. You now have a complete system. Prepare the dossier, enforce the apples-to-apples rule, launch the three-pronged attack, use the conversation playbook, and then leverage the results. This is how you take control. This is how you guarantee you are not overpaying by a single cent. You've won the battle of the quote. But winning the war means understanding the contract you're about to sign. Because the cheapest policy isn't always the best one. And the most dangerous mistakes aren't found on the price tag. They're buried in the fine print. And dissecting that fine print, to make sure your cheap policy doesn't become the most expensive mistake of your life, is exactly where we're headed next. Let's talk about your policy's declarations page. It sounds boring, I know. It sounds like something you'd find in a dusty legal textbook. But this single piece of paper is the Rosetta Stone of your auto insurance. It's the one-page summary that translates all the confusing jargon into cold, hard numbers. It's the map that shows you exactly where the financial cliffs are. If you ignore everything else, you must understand this page. Because this is where the cheap policy you bought online at 2 in the morning reveals its true, and often terrifying, nature. The first, and by far the most important set of numbers you'll see are your liability limits. They usually look something like a fraction, 25/50/25 or 50/100/50. This isn't a secret code. It's the absolute maximum amount of money your insurance company will pay out if you cause an accident. And understanding these three numbers is the difference between a bad day and a ruined life. Let's break it down with a real-world scenario. Meet Mark. Mark is a smart guy, a savvy shopper. He found a policy that was $30 a month cheaper than his old one by selecting the state minimum liability coverage, which in his state was 25/50/25. He felt like he'd won. $30 a month is $360 a year. That's a nice dinner out, a new gadget. He was proud of his savings. Then one rainy Tuesday, Mark was pulling out of a parking lot. He was distracted for a split second and his foot slipped. He rolled into traffic and clipped the back of a brand new Lexus SUV. It wasn't a high-speed crash. Nobody seemed seriously hurt. The airbags didn't even go off. An inconvenience, he thought. This is what I have insurance for. But here's what those numbers, 25/50/25, actually meant for Mark. The first number, 25, stands for $25,000. That's the maximum his policy will pay for bodily injury to a single person in an accident he causes. The second number, 50, is the $50,000 maximum his policy will pay for bodily injury for the entire accident, no matter how many people are hurt. And that third number, 25, is the $25,000 maximum his policy will pay for all property damage. The estimate to repair the Lexus came back. With its fancy sensors, custom paint, and specialized parts, the bill was $32,000. Mark's policy covered property damage up to $25,000. Right off the bat, Mark was personally on the hook for $7,000. His $360 in annual savings vanished in an instant, and he was already deep in the red. But it got worse. The driver and passenger of the Lexus, a married couple, went to the doctor complaining of neck and back pain. Whiplash. It's a common injury in rear-end collisions, and the medical bills can spiral out of control with exams, physical therapy, and follow-up appointments. The driver's medical bills eventually totaled $35,000. Remember Mark's limit? $25,000 per person. His insurance paid the $25,000, and Mark was handed a bill for the remaining $10,000. The passenger's bills were $18,000, which was thankfully under the limit, so insurance covered that. Let's do the math. Mark is responsible for $7,000 for the car repair and $10,000 for the driver's medical bills. That's $17,000 out of his own pocket. His savings account was wiped out. He had to take out a personal loan, all to save $30 a month. That cheap policy became the most expensive decision he ever made, turning a minor fender bender into a multi-year financial disaster. The brutal lesson here is that state minimums are a trap. They are a financially irresponsible choice for anyone with a job, a savings account, or any assets to their name. Because if you don't have the money to pay, guess what happens? The other party's lawyers will come after you. They can garnish your wages. They can put a lien on your house. They can seize your assets. So what's the solution? You need to raise your limits. A good starting point for most people is 100/300/100. That's 100,000 for a single person's injuries, 300,000 total for injuries, and 100,000 for property damage. And here's the kicker. The price difference to jump from a dangerously low 25/50/25 to a much safer 100/300/100 is often shockingly small. We're talking maybe $15, $20, or $25 a month. It is the single most valuable, most important upgrade you can make to your policy. It's buying life-altering peace of mind for the price of a few cups of coffee. Next on your declarations page, you'll find your deductibles. This is the amount of money you have to pay out of pocket before your insurance kicks in to fix your car. This brings us to another common trap, the high deductible delusion. You're getting quotes online, and you see a slider for your deductible. You slide it from $500 to $1,000, and wow, your premium drops by $20 a month. You slide it to $2,000 and it drops even more. Feels like free money, but it's not. You have to ask yourself one brutally honest question. If I get in an accident tomorrow, can I comfortably write a check for that deductible amount without causing a financial crisis in my household? If your deductible is $1,500, but you only have $500 in your emergency fund, your deductible is too high. Period. Saving $20 a month is pointless if you have to put a $1,500 repair bill on a credit card with 22% interest because you couldn't cover the deductible. The interest payments alone will obliterate any savings you thought you were getting. Your deductible should never be higher than what you have readily available in cash in an emergency fund. Don't lie to yourself about this. Be honest about your financial reality. Finally, let's talk about the two coverages that actually protect your vehicle: collision and comprehensive. People throw around the term full coverage, but it doesn't actually exist. It's a marketing phrase. What they mean is a policy that includes liability, collision, and comprehensive. Collision is simple. It pays to fix your car if you hit something, another car, a pole, a guardrail, and it's your fault. Comprehensive is for almost everything else. Think of it as the acts of God and chaos coverage. A deer jumps in front of you. A tree branch falls on your roof during a storm. Your car is stolen. It's vandalized. Hail turns your hood into a golf ball. That's all comprehensive. For both of these, your deductible applies. The trap here isn't having them. It's knowing when to get rid of them. As your car gets older, its value plummets. At some point, you're paying for protection that just isn't worth it anymore. So how do you know when to drop them? Use the 10% rule. It's a simple guideline. Take the annual cost of your collision and comprehensive premiums, not your total premium, just those two parts, and compare it to your car's actual cash value. You can look this up on a site like Kelley Blue Book. If your annual premium for these coverages is more than 10% of your car's value, it's time to seriously consider dropping them. For example, your 10-year-old car is worth $4,000. You're paying $500 a year for collision and comp. That's more than 10%. If you total the car, your insurance company will write you a check for $4,000, minus your, say, $500 deductible. So you get $3,500. Was paying $500 a year for that $3,500 payout worth it? Maybe. But as the car gets older and its value drops to $3,000, then $2,000, the math no longer makes sense. You're better off banking that $500 a year yourself into a new car fund. Understanding your liability limits, your deductibles, and your vehicle coverages forms the foundation of a smart policy. This is the core of what you're paying for. But we're not done digging through the fine print. Because nestled in that policy are a series of optional coverages. They look like add-ons, like upsells you're supposed to say no to, but a few of them are secret weapons, the things that can save you from the single biggest threat on the road today. And that threat isn't a drunk driver or a patch of ice. It's the person driving right next to you with little or even zero insurance of their own. They're everywhere. 1 in 8 drivers in this country has no insurance at all. 1 in 8. And that's just the ones with zero coverage. The number of drivers with the bare minimum, the kind of policy that wouldn't even cover a new bumper on a modern car, is astronomically higher. So what happens when that person, the one texting and drifting over the yellow line, plows into you? You do everything right. You have great insurance. You pay your premiums on time. You're a safe driver. But in that split second, none of it matters. Your car is mangled. You're hurt. The other driver gets out, maybe they apologize, maybe they don't. You exchange information. And that's when the nightmare begins. You call their insurance company, and you get one of two soul-crushing responses. The first is, "We have no record of a policy for that individual. They were uninsured." A ghost. You can sue them, sure. But suing someone with no insurance is like trying to squeeze water from a rock. They have no assets. You'll win a piece of paper, a judgment, that's worth less than the legal fees you paid to get it. The second response is even more insidious. The agent on the phone says, "Yes, we have a policy for them. They have the state minimum liability coverage of $15,000. You think, okay, $15,000, that's something. But then you get the estimate for your car. It's $22,000 to repair. You get the first bill from the emergency room. Just the ambulance ride and the initial checkup is $10,000. And you haven't even gotten to the specialist, the physical therapy, the weeks of lost wages from being unable to work. That $15,000 from their policy? It's a single drop of water on a raging fire. It's gone before you can even blink. And you are left holding the bag for tens, or even hundreds of thousands of dollars in damages and medical bills. This is the moment where responsible people like you, have their lives ruined. They lose their savings. They go into medical debt. They lose their car and can't get to work. It's a downward spiral that starts with someone else's mistake and is accelerated by their irresponsibility. But it doesn't have to be your story, because you can build a fortress around your finances. You can hire a personal financial bodyguard that rides with you in your car every single day. And it's called uninsured and underinsured motorist coverage. This is not a luxury. This is not an add-on. In today's world, this is as essential as your own liability insurance. It is, without a doubt, the single most important coverage you can buy to protect yourself and your family. Let's break it down because there are two parts and they are your secret weapons. First, uninsured motorist coverage, or UM. This is your shield against the ghosts. When the person who hits you has zero insurance, your own insurance company steps in and plays the role of the at-fault driver's insurance. They pay for your medical bills. They pay for your lost wages. They pay for your pain and suffering. They pay to fix or replace your car, depending on the specifics of your policy. Instead of chasing a person with no money, you are dealing with your own trusted company. You are making a claim on your policy to cover someone else's catastrophic failure. Now for the second and arguably more common threat, the underinsured driver. This is where underinsured motorist coverage, or UIM, becomes your savior. Remember our scenario? The person who hit you had a pathetic $15,000 policy. Your medical bills are $100,000. Their insurance pays out its max of $15,000. What about the other $85,000? That's where your UIM coverage kicks in. It bridges the gap between their tiny limit and your actual costs. It is literally your own insurance saving you from the consequences of someone else choosing the cheapest, most useless policy they could find. So the big question is, how much do you need? The answer is simple and non-negotiable. You should have at least as much uninsured and underinsured motorist coverage as you have bodily injury liability coverage. Let me repeat that. Your UM and UIM limits should mirror your own liability limits. If you have a policy that protects others to the tune of $250,000 if you cause an accident, You should have a policy that protects you to the tune of $250,000 if a broke, uninsured driver hits you. Why would you value a stranger's health more than your own? Why would you give them a better safety net than you give yourself? It makes no sense, yet millions of Americans have massive liability limits and tiny, state minimum UM/UIM limits. It's a ticking financial time bomb. You're probably thinking this sounds expensive. You're thinking, great, another thing to add that's going to jack up my premium. I want you to listen very, very closely. Uninsured and underinsured motorist coverage is the single greatest bargain in the entire insurance industry. It is dirt cheap. We are talking about pennies on the dollar. Raising your limits from the state minimum of, say, $25,000 up to $250,000 might cost you $5, maybe $10 a month. The price of 2 cups of coffee. That's it. For less than the cost of a Netflix subscription, you can buy a $250,000 force field that protects you from financial ruin at the hands of an irresponsible stranger. There is no better return on investment for your peace of mind. Now, I want to share a pro-level tip that your insurance agent might not even tell you about unless you ask. It's a concept called stacking. This is a powerful multiplier for your underinsured motorist coverage, and it's available in many states. Let's say you have 2 cars on your policy, and you have $100,000 of UIM coverage on each car. If you opt for stacked coverage, in the event of a serious accident with an underinsured driver, you can literally stack those 2 limits on top of each other. Suddenly, your $100,000 limit becomes a $200,000 limit. If you have 3 cars, it becomes $300,000. It's a way to dramatically increase your protection for a very small additional premium. Not all states offer it, and the rules vary, but you absolutely need to ask your agent 2 questions. Is stacked UM/UIM coverage available in my state? And how much would it cost to add it to my policy? The answer will probably shock you with how affordable it is. So here is your homework. Sometime today or tomorrow at the latest, pull up your auto insurance policy. You can find it on your insurer's app or website. Look for the declarations page. Find the lines that say uninsured motorist bodily injury and underinsured motorist bodily injury. Look at the numbers next to them. Now look at your own bodily injury liability limits. Are they the same? If your UM/UIM limits are lower, you have a critical vulnerability in your financial armor. You are one bad driver away from a potential disaster. Your next step is to call your agent or go online and get a quote to raise those limits to match your liability coverage. I promise you, the peace of mind you will get from making that one small change is immeasurable. You are closing a loophole that has the power to destroy everything you've worked for. Protecting yourself from the outside world is paramount. But what happens when the accident is more complicated? What if it's your fault? Or what if it's a bizarre situation where fault is unclear, but you and your passengers are injured and need medical care right now, not after months of legal battles? Who pays for your ambulance ride, your emergency room visit, your health insurance deductible right away with no questions asked? Your health insurance might, eventually. But there is a faster, better, and more direct line of defense built right into your auto policy that many people completely misunderstand or ignore. It's your first payer in an accident, and it's a critical piece of the puzzle we need to solve next. This crucial coverage is called medical payments, or MedPay for short. In some states, it's a more powerful mandatory version called personal injury protection, or PIP. And understanding the difference between this and your health insurance is the key to unlocking a layer of financial armor you probably didn't even know you were missing. Think about it. After a car accident, what's the first and most stressful bill that arrives? It's not the body shop estimate. It's the ambulance bill. It's the emergency room bill. It's the bill for the x-rays and the CT scan. These can show up in your mailbox in a matter of days, demanding payment, while the insurance companies are still trying to figure out who is at fault. This is where the nightmare begins for so many people. They think, I have health insurance, I'm covered. But they forget about the $5,000 deductible, or the 20% co-insurance, or the fact that their health plan might not cover specific treatments, like chiropractic care or dental work if a tooth gets chipped. So, while you're waiting weeks, maybe months, for the other driver's insurance to accept liability and pay up, those medical bills are sitting on your kitchen counter going to collections and destroying your credit score. Your health insurance company, meanwhile, might pay some of it after you meet your deductible, but then they'll often turn around and try to get their money back from the at-fault party's insurance in a process called subrogation. It's a slow, messy, bureaucratic tug of war. And you are the rope. MedPay and PIP cut right through all of that noise. They are your immediate financial first responders. Let's start with MedPay. This is the simpler of the two. It's an optional coverage in most states, and it is beautifully straightforward. It pays for the medical and funeral expenses for you and anyone in your car who is injured in an accident, up to your policy limit, regardless of who was at fault. Read that again, regardless of fault. This means if someone runs a red light and T-bones you, you don't have to wait for their insurance to do an investigation. You don't have to fight with an adjuster who's trying to lowball you. Your MedPay kicks in immediately. You go to the emergency room, you give them your auto insurance information, and the bill gets paid up to your limit. Is that clean? Let me paint you a picture. Let's say you have a $5,000 health insurance deductible, and you carry a $5,000 MedPay limit on your auto policy. You get into a minor fender bender, and just to be safe, you and your passenger go to the ER to get checked out. The bill for the two of you comes to $4,000. Without MedPay, you are on the hook for that entire $4,000 out of your own pocket to satisfy your health insurance deductible. You'd have to drain your savings account while you hope and pray the other driver's insurance eventually reimburses you. But with MedPay, your auto policy pays that $4,000 bill in full. You pay zero. Your passenger pays zero. Your health insurance isn't even involved. You haven't touched your deductible. Your savings are safe. For the cost of a few extra dollars a month, you just saved yourself $4,000 in cash and an immeasurable amount of stress. It's a financial firewall. It covers health insurance deductibles, copays, and even things your health insurance might deny. Now let's talk about its bigger, stronger cousin, personal injury protection or PIP. If you live in what's called a no-fault state, like Florida, Michigan, or New York, among others, you are likely required to carry PIP. And while people in those states sometimes complain about the cost, they often don't realize the incredible safety net it provides. PIP does everything MedPay does. It pays your medical bills regardless of fault, but it adds two absolutely game-changing benefits. It can cover lost wages, and it can cover replacement services. This is where it goes from being a convenience to being a lifeline. Imagine you're a freelance graphic designer or an Uber driver. You break your arm in a car accident. You can't work for 2 months. Your medical bills might be covered, but how do you pay your rent? How do you buy groceries? Your income just vanished. This is a scenario that pushes families to the financial brink. PIP steps in. It will reimburse you for a significant percentage, often up to 80%, of your documented lost income while you recover. It's like having built-in disability insurance right in your car insurance policy. And what about replacement services? Let's say you're a stay-at-home parent with 2 young kids. You're in an accident and you're laid up for a month, unable to care for your children, cook, or clean the house. PIP can help pay for things like childcare or a cleaning service, essential services you can no longer perform due to your injuries. It keeps your household running when you physically can't. So how does carrying more coverage actually save you money in the long run? Seems backward, right? First, as we saw, it directly saves you from paying massive out-of-pocket health insurance deductibles and copays. The monthly cost to increase your MedPay from a useless $1,000 to a very useful $10,000 is often laughably small. Yet it can save you from a $5,000 or $10,000 bill overnight. It's one of the best return on investment decisions you can make in your entire financial life. Second, it keeps your claims simple and contained. Insurance companies love simple claims. When your medical bills are paid quickly by your own PIP or MedPay, you're made whole. You're not angry, you're not desperate, and you're far, far less likely to hire a personal injury attorney. The moment lawyers get involved, the cost of a claim skyrockets for the insurance company. And when an insurance company's costs go up, what do? They raise rates for everybody. By using MedPay and PIP to handle injuries efficiently, you're helping to keep the entire system more stable, which helps keep rates down over the long term. The most dangerous and common mistake people make is saying, "I have excellent health insurance, so I'll just decline MedPay or take the lowest possible limit." This is a catastrophic misunderstanding. Your health insurance does nothing for your passengers. It does nothing for your lost wages. It does nothing to protect you from that initial cash crunch of a high deductible. And it does nothing to pay the ambulance that shows up at the scene of the crash. So here is your mission, and it's a critical one. Pull out your auto insurance policy declaration page right now. Find the line for medical payments or personal injury protection. What is your limit? For millions of Americans, it's the state minimum, a paltry $1,000 or $2,000, an amount that can be wiped out by a single ambulance ride. Then call your agent or log into your insurance company's app and get a quote to increase that coverage. Don't just double it. Ask for a quote for $10,000, $25,000, even $50,000. You will be absolutely stunned to learn that raising this coverage tenfold might only increase your premium by the cost of one latte a month. It is without a doubt the cheapest and most powerful financial protection you can buy. You are essentially prepaying your health insurance deductible and your passengers' deductibles for pennies on the dollar. By making sure you and your passengers are taken care of immediately, you've solved the first, most urgent problem in any accident. You've built a fortress around your own health and your own savings. But this only solves half of the equation. It protects you from your own costs. What happens when the person who hits you has no insurance at all, or they carry the absolute bare minimum state limits that can be exhausted by a single night in the hospital? You could win a lawsuit against them for $1 million, but you can't get blood from a stone. This is where a terrifying gap exists in most people's coverage. A gap that can lead to total financial ruin. And plugging that gap is what we have to tackle next. That gap is created by one of the most sobering and frustrating realities of our society. You can do everything right and still be left financially destroyed by someone who did everything wrong. You can be the most responsible driver on the planet, with $1 million of liability coverage to protect others, a perfect driving record, and a car maintained like an aircraft. And then one afternoon, someone texting and driving runs a red light and plows into you. The accident is 100% their fault. But as you're lying in a hospital bed, your world gets turned upside down a second time when you discover the driver who hit you has the absolute bare minimum insurance required by your state. Or even worse, no insurance at all. Suddenly, your own $1 million liability policy is completely useless. That policy is designed to pay other people if you cause an accident. It does absolutely nothing to help you when someone else is at fault. Your health insurance will help with the medical bills, of course, but it won't pay your mortgage while you're out of work for 6 months recovering. It won't compensate you for a permanent injury that will affect your quality of life forever. It won't cover the immense pain and suffering you and your family are enduring. The at-fault driver is legally responsible for all of that. But their insurance policy, the one they bought for the lowest possible price just to be legal, only covers, say, $25,000. That amount is vaporized by the first night in the ICU. So what about the rest? What about the hundreds of thousands of dollars in damages you are now facing? You can sue the driver and you'll win. But what then? They don't have the money. They don't have the assets. You are left holding a court judgment that's worth less than the paper it's printed on. This is the gap. This is the financial black hole that swallows responsible people whole. And the way you plug it is with two of the most criminally misunderstood and undervalued coverages on your entire policy: uninsured and underinsured motorist coverage. Let's call them UM and UIM for short. Think of this as insurance you buy on other drivers. It is a shield you hold to protect yourself from the massive and growing risk of financially irresponsible people on the road. Let's break them down. Uninsured motorist, or UM, coverage protects you if you are hit by a driver who has no insurance at all, or if you are the victim of a hit and run where the driver is never found. In this country, it's estimated that 1 in every 8 drivers is uninsured. In some states, that number is closer to 1 in 4. That means on your daily commute, you are sharing the road with dozens, if not hundreds, of drivers who are financial ghosts. If they injure you, they will simply disappear, and you will be left with all the bills. Your UM coverage steps into the shoes of the uninsured driver and pays you for your medical expenses, your lost wages, and your pain and suffering, up to the limits you select. Then there's underinsured motorist, or UIM coverage. This is arguably even more important because the scenario is far more common. UIM protects you when you're hit by a driver who has insurance, but their liability limits are too low to cover your damages. And let's be brutally honest, nearly everyone carrying state minimum coverage is, for all practical purposes, underinsured for a serious accident. State minimums in many places are a joke. We're talking $25,000 or even $15,000 for bodily injury. That might not even cover the ambulance ride and the initial emergency room visit. Let's walk through a real-world example. You're in a serious accident that was not your fault. After months of treatment, your total damages are calculated. You have $150,000 in medical bills, you've lost $50,000 in wages from being unable to work, and you're awarded another $100,000 for pain, suffering, and the permanent limp you now have. Your total damages are $300,000. The driver who hit you has a state minimum policy of $25,000. Their insurance company promptly writes you a check for their full policy limit of $25,000. You are still short $275,000. $275,000 that you are on the hook for. This is where lives are ruined. But if you had the foresight to protect yourself, your own underinsured motorist coverage now kicks in. If you had selected UIM limits of, say, $300,000, your own insurance company would step in and pay you that remaining $275,000. Your own policy becomes your safety net. It backstops your financial life against the irresponsibility of others. So how much should you get? The answer is simple, and it should be a non-negotiable rule of thumb for every single person. Your uninsured and underinsured motorist coverage limits should be exactly the same as your bodily injury liability limits. Period. The logic is undeniable. If you believe that you should have $250,000 of liability coverage to protect a stranger's family if you make a mistake, on what planet would you not want the exact same amount of coverage to protect your own family if a stranger makes a mistake? You are insuring your most valuable asset, your health, your income, and your family's future. The cost to raise your UM/UIM limits is typically a fraction of what it costs to raise your main liability, making it the single best value in all of insurance. Do not skimp here. Ever. Now, for those of you who want to take your protection to the next level, we need to talk about a powerful feature available in many but not all states. It's called stacking. If you have multiple vehicles on your policy, stacking allows you to combine the UM/UIM coverage from each vehicle to create a much larger pool of coverage for a single accident. Here's how it works. Let's say you have 2 cars on your policy, and you've chosen $100,000 in UM/UIM coverage for each. If you have non-stacked coverage, your maximum payout for any one accident is $100,000, regardless of which car you were in. But if you pay a little extra for stacked coverage, you can now add those limits together. In an accident, you would have a total of $200,000 in UM/UIM coverage available to you. If you have 3 cars, that becomes $300,000. It is a massive force multiplier for your protection, and the additional premium is often incredibly reasonable for the peace of mind it provides. If stacking is available in your state, you need to have a serious conversation with your agent about it. It's easy to get lost in the weeds of trying to save $7 a month on your premium. We've all done it. But we have to zoom out and look at the big picture. We are not just insuring a piece of metal. We are building a financial fortress around our lives. Raising your deductible on an old car to save money makes sense. Lowering your uninsured motorist coverage to save a few dollars is financial insanity. It's like canceling your health insurance because you feel fine today. You are betting your entire future against the odds of encountering one of the millions of uninsured or underinsured drivers on the road. That is a bet you cannot afford to lose. We've now built the main walls of our fortress. We've protected our assets from lawsuits with high liability limits, and we've protected ourselves from the outside world with high uninsured and underinsured motorist limits. But what happens in the immediate aftermath of a crash? Before fault is determined, before lawyers get involved, before any of that, who pays for the ambulance? Who pays for the immediate ER visit or the co-pays for your physical therapy? Your health insurance helps, but what about the deductibles and out-of-pocket costs? And what if your passengers don't have good health insurance? The answer involves too little coverages that are constantly confused, and choosing the right one can make a world of difference in the first critical weeks after an accident. And that choice is what we need to break down next. The 2 coverages are medical payments, often called MedPay, and personal injury protection, universally known as PIP. They sound similar, they both deal with injuries, but they operate in fundamentally different worlds. Understanding which one you need, or if you need one at all, is one of the most misunderstood parts of an auto policy. Let's start with medical payments coverage, or MedPay. Think of MedPay as your policy's first responder. It's designed to pay for immediate and necessary medical and funeral expenses for you and your passengers after an accident, regardless of who was at fault. It's simple, it's fast, and it's direct. The key words there are regardless of fault. If you get rear-ended, you don't have to wait for the other driver's insurance to admit liability and start processing claims. Your MedPay can kick in right away to cover the ambulance ride, the emergency room visit, the x-rays, the initial doctor's appointments. It's no-fault coverage for your body. It covers you, your family members, and any passengers in your car. It even covers you and your family if you're injured as a pedestrian or a cyclist hit by a car. It is incredibly broad in who it protects, but it's also incredibly specific in what it protects. Notice the name, medical payments. That's all it does. Pays for medical bills. It does not pay for lost wages if you can't work. It does not pay for physical therapy down the line. It does not pay for someone to help around the house if you're laid up with a broken leg. It is a financial band-aid for the initial wound, and that's it. MedPay coverage limits are also typically lower, often ranging from $1,000 to $10,000. It's not designed for catastrophic injuries. It's designed to plug the immediate financial hole. So why would you get it, especially if you have good health insurance? This is the million-dollar question. The answer is your health insurance deductible. Let's say you have a great health plan, but it comes with a $5,000 deductible. After an accident, you go to the hospital. The bill is $7,000. Your health insurance will not pay a dime until you've paid that first $5,000 out of your own pocket. That is a massive, unexpected expense that most people don't have just sitting around. This is where MedPay becomes your secret weapon. You can use your $5,000 MedPay coverage to pay your $5,000 health insurance deductible. The auto insurance pays the health insurance. Suddenly, that massive out-of-pocket cost vanishes. For what often amounts to just a few extra dollars a month on your premium, MedPay acts as insurance for your health insurance deductible. It's an incredibly powerful tool for sealing the cracks in your financial foundation. Now let's talk about the other option, personal injury protection, or PIP. If MedPay is a financial band-aid, PIP is a full-blown trauma kit. Like MedPay, PIP is also a no-fault coverage. It pays for your medical expenses after an accident regardless of who is to blame. But that's where the similarities end. PIP goes so much further. It's designed not just to treat the injury, but to help you manage your life while you recover from that injury. The single biggest difference is that PIP covers lost wages. If you're out of work for 6 weeks recovering, PIP can reimburse you for a significant portion of your missed paychecks. For most families, this is the difference between weathering the storm and facing financial ruin. A medical bill can be put on a payment plan. A mortgage payment cannot. But it doesn't stop there. PIP can also cover what are called essential services. If you're the primary caregiver for your children and can't look after them because of your injuries, PIP can help pay for childcare. If you can't clean your house or mow your lawn, it can help pay for those services. It is a comprehensive safety net designed to keep your life running as normally as possible while you heal. So, PIP is clearly superior, right? It covers everything MedPay does and a whole lot more. So why doesn't everyone just get PIP? The answer comes down to where you live. Your ability to get PIP, and in many cases your requirement to have it, is determined by your state's laws on auto insurance. States in the U.S. generally fall into two categories: at-fault states and no-fault states. In an at-fault state, the person who causes the accident is responsible for paying for all the damages, including the other party's medical bills. In these states like California or Texas, PIP is usually not available. Your option is to add MedPay to your policy as that optional, fast-acting coverage for your own injuries while you wait for the other party's insurance to pay up. But in no-fault states, the system is different. In states like Florida, Michigan, or New York, the whole concept is to avoid lengthy legal battles over who caused a crash. Instead, the law says that your own auto insurance is the primary payer for your own injuries, up to a certain limit, no matter who was at fault. And to make that system work, these states mandate that drivers carry personal injury protection. So, the choice between MedPay and PIP might not be a choice at all. It might be decided for you by your zip code. The first step is to do a quick search online for, is your state a no-fault state? If the answer is yes, then you are required to have PIP. Your mission isn't to choose it, but to understand it. Your state will have a minimum required coverage amount. You need to look at that amount and ask yourself, is this enough? Is $10,000 in PIP coverage enough to cover my medical bills and my lost wages if I'm out of work for a month? If you're the primary breadwinner for your family, you may want to consider purchasing higher PIP limits. If the answer is no, you live in an at-fault state, then you likely have a real choice to make about adding MedPay. And this is where we bring it all back to saving money by making smart choices. Look at your health insurance policy. What is your deductible? What is your maximum out-of-pocket expense? If you have a high deductible plan, adding a few $1,000s of MedPay coverage is one of the cheapest and most effective ways to protect yourself from a sudden, massive medical bill after a car accident. Call your agent and ask for a quote to add $5,000 in MedPay. You might be shocked to find it costs less than a couple of fancy coffees a month. That is an incredible return on investment for your peace of mind. And with that, we've reached the end of our journey. Over these 10 parts, we've deconstructed every piece of the auto insurance puzzle. We've looked at how your personal profile, your driving record, your credit, your age shapes your rates. We've seen how the car you choose is half the battle, with safety features and repair costs playing a huge role. We've pulled apart the policy itself, demystifying liability, collision, and comprehensive, and we've just seen how MedPay and PIP can be your financial lifeline. We've uncovered the hidden power of stacking, the simple magic of bundling, and the undeniable importance of shopping around. The goal was never just to save you a few dollars. It was to empower you. Auto insurance is one of the most common, yet most confusing financial products we are forced to buy. Companies rely on that confusion. They count on you just renewing your policy without asking questions, without understanding what you're paying for, without knowing that you have the power to change it. That ends today. You are now armed with the knowledge to walk into any negotiation with an insurance agent, not as a customer, but as an expert on your own needs. You know the right questions to ask. You know which coverages are critical and which are optional. You know how to hunt for every last discount you're entitled to. This isn't just about a car. It's about protecting your family, your assets, and your financial future. The timeless tips aren't just tricks. They are principles of financial responsibility. Drive safe, maintain good credit, choose your vehicle wisely, build a policy that truly protects you, and never ever stop asking if you can do better. Because you almost always can. You are now in the driver's seat in every sense of the word. Thank you for taking this ride with me.